Right, we are knee-deep in profit stories. Earnings season is upon us, and it comes with the stock market in North America at all-time highs. Jamie Murray is president of the Murray Wealth Group, and he joins us in studio to talk about some of those earnings stories and the state of the markets. Jamie, it's good to see you.
Thanks for having me.
Let's just dive straight into some of these different earnings reports. And, I think these are always just a snapshot in time, but people have to make investing decisions as well. We've covered General Motors a lot this morning, and I think biggest takeaway is that tariffs created tensions for their business and their profitability. But when you look at a company like GM, what do you see right now?
Yeah, I think GM's really, there's kind of two parts of the market right now. Those that are severely affected by tariffs, and they can't really give a good guide for the year. They don't even know what the tariffs are going to be next week when, new trade deals maybe are announced or new rates go into effect. And then there's this whole other group of companies that tariffs, we don't really think about them, or they're not impacting our business at all. And certainly, I think you're going to see those type of companies potentially outperform if you can level set a good guide and show that tariffs aren't affecting your business. That's going to be build a lot of confidence.
And just because a company is in a sector that seems to be caught up in the tariff story, doesn't mean that you're necessarily going to shy away. Like, I don't believe you own GM, but you do have some exposure to the auto parts sector in Canada, don't you?
Yeah, exactly. So we own a company called Linamar, which is a big supplier for GM. And we actually think Linamar will benefit from some of these tariffs and the noise that's going on around it. So Linamar sells all of its products USMCA compliant, which right now don't have any tariffs on them. Now, certainly it affects Linamar that GM has tariffs, and that might affect volumes, but we're seeing GM shift more production to the U.S. Linamar is going to be a supplier to that new production, particularly as they move away from ICE or back to ICE from electric vehicles. That benefits Linamar as well, as they have a big components into these big pickup trucks and vans that GM sells. And so we think this is a company that can actually benefit by being less impacted than maybe others in the sector, like a European supplier.
Well, I'm glad you mentioned Europe as well, because we've seen a lot of announcements specifically tied to the U.S. with investing in the U.S., whether that's to appease the Trump administration or ultimately good business. How do you view that? Like, one example I think that some people have been talking about, AstraZeneca, a company that's made sort of a fairly large commitment to the U.S. in terms of their spending, their CapEx spending.
Right. So AstraZeneca this morning committed to $50 billion over the next several years to the United States. We've seen a lot of these announcements. Apple's made the $100 billion announcements. And so we get these. A lot of the spending was already going to occur. It's just the company making a bit of a show for it, because we all know Mr. Trump likes it when you put on a bit of a spectacle, and he can take some credit for that. But certainly AstraZeneca, the CEO, it's headquartered in the UK, and they're not happy with the business environment in the UK. And despite the tariff side of the equation, the US is also doing a lot of things right on the deregulation front. And I think that's going to draw companies, particularly in these high tax, high regulation jurisdictions, into their economy.
I mean, on the investment side, just as an example, with a company like AstraZeneca, especially if you have to sort of take a closer look at specifically how much new spending is tied to these announcements. But, they're obviously in the pharma game. Is that a company that you would even look at, or?
Yeah, so AstraZeneca is actually one of our largest holdings in our global equity growth portfolio. So we really like it. And I think AstraZeneca is looking at a company like, let's say, Eli Lilly, which we also own. Eli Lilly trades at a huge multiple premium. Now, it is growing faster. There's reasons the PE ratio is much higher, but
they got the weight loss drug.
They got the weight loss drug. Their revenue is going to grow double digits for the next 4 or 5 years. AstraZeneca is going to grow at a slower rate, but it trades at a 14 PE. We're going to see earnings grow probably double digits over that time period. So I think AstraZeneca is saying, hey, this is actually impacting our business. It's going to be good for shareholders to make this move. For multiple reasons, not just the deregulation.
I know you guys keep tabs on tech as well. We'll start to more specifically get into tech with companies like Tesla and Alphabet reporting this week. Alphabet's kind of been an interesting story, I think, because everybody talks about the AI excitement, and Google's parent company definitely has invested tons in AI, perhaps was in the AI game before anybody else. But now we're kind of at this point where everyone's trying to figure out what's that going to mean for their search business. And I wonder what you think, or what you would be curious to hear from the company on the AI front.
Yeah, that's a great point, and we're actually large shareholders in Alphabet as well. So we really like this company, but certainly it has been impacted by that noise that you talked about. And so what we're looking for on the call is we want to see its large user base using its AI products more and more. That creates stickiness. That means that if they're using it with Alphabet, they're probably not going to run to another competitor. And so we want to see that velocity of new product launches increase. We want to see the uptake increase. And this actually opens up a bit of a window for Google to manage the street by saying, look, our EPS, our expenses might be a little bit higher. EPS maybe isn't going to be growing as quickly as some of our other peers, but that's because we're going through this investment phase where we're building out this great AI business. And if they can point to that and say in 2 or 3 years, we're going to be one of the top 2 or 3 AI companies in the world, then I think investors will look through that and get excited about the story again.
The tech sector's strength kind of skews this story of all-time highs, because not every company in TSX land or S&P 500 land has been moving to record levels. But I think the fact that we're at all-time highs sort of invites the question, where can you find value? Now, a couple of stocks that you just wanted to sort of flag this morning where you see value in the Canadian market, just as an example, would be Chemtrade and also Exchange Income. Let's talk about Chemtrade for a second. A chemical producer, which when you look at the valuation looks pretty good to you, correct?
Yeah, exactly. So in Canada particularly, we think there are going to be a couple more interest rate cuts. And so we're looking for companies that pay big dividends, low payout ratios, and where we can see that valuation expand throughout the next year. And so Chemtrade's a great example of that. It's trading at a 5 times EV/EBITDA multiple. That's way below its peers, way below historical averages. And I mean, a lot of that's because this company had a bit of a rough go prior to COVID and actually cut its dividend in that COVID 2020 period. But since then, there's a new CEO. They're running the business at a very high level. The payout ratio's down to 40%. The dividend's still 6.5% on a yield basis. They're growing the dividend every year. They're buying back stock. So everything's going right with Chemtrade. They've got a great asset base, and this is one we think is going to go way higher. And
then Exchange Income. The name doesn't necessarily sort of highlight this fact for you, but in terms of aerospace, it's an interesting business.
Yeah, exactly. The name of the company doesn't necessarily reflect the underlying assets, but this is a company that over the last 20 years has built up, I think, the most unique collection of aerospace assets, certainly in Canada, but maybe even globally. So they own lots of small regional players that service the northern Canadian markets. They also provide medical evacuation, air ambulance services in these remote communities. And they've just done an acquisition to buy a company called Canada North, which services the Nunavut market. And now these are huge opportunities over the long term as Canada looks to invest more in its northern resources and potentially in defense and gold, copper mining. So this is just a company that we think is a great way to get exposure to this that isn't really right there on the surface.
That's a really interesting point, because that is, everybody's watching trends, and for Canada, that's definitely a trend to watch. And it is a well-liked stock, according to Bloomberg. More than 90% of the analysts